You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host, John McEwen. In this week's episode, we're going to be discussing Autotrader, AstraZeneca, DS Smith, Ocado, Marks and Spencer's, Sainsbury, and Upwork. Shall we start with Autotrader then?
Yes, let's start with Autotrader. So what have Autotrader said this week?
So Autotrader have released their half-year results to the end of September. So I'll just go through some of the key figures in there. So the number of car dealerships, they said, had fallen 2% to 13,056.
Yeah.
They said the average revenue per retailer had fallen £745 to £1,206 per month. They've said the number of cars being advertised on Autotrader fell 1%. So that's basically flat, isn't it?
It sounds it, yeah.
Yeah, so it's just that average revenue per retailer, so the car dealerships. So the average number of visits, they said, actually increased 12% to 57.3 million a month.
It's not what you'd expect in the current environment, but
It's
I suppose there's that sort of feeling that are people going for big one-off purchases at the moment because they don't feel so badly hit, and perhaps the pain is yet to come from that point of view, but also that they haven't been able to go on big holidays abroad, and whether this is sort of that sort of pent-up demand for some sort of big purchase.
It's quite impressive because that 12% rise in visits, that's come despite a 65% reduction in marketing. But interestingly, it looks like a lot of the people, they must just be window shopping. Revenue actually fell 38% despite the increase in visits. I'd interpret that as a lot of people are going on, possibly hoping that prices had fallen more than they had.
Yeah, finding they hadn't.
Yeah, and hoping that they'd get more desperate sellers maybe.
Yeah.
But I suppose it's still good because that's 12% more people going on per month who are possibly going to buy a car at some point. So yeah, so revenue fell 38% to 100.2 million, and operating costs fell 11% in the period, which makes sense because it's a platform. You'd expect the majority of the costs to be fixed. So because of that, operating margins were down to 58% compared to 70% last year.
Yeah.
The group said
they've given holidays, sort of ad fee-free holidays in terms of advertising to their bigger dealers.
Yes, so they suspended advertising fees for the lockdown, and they've said they're going to do the same in the second lockdown. So yeah, so that's going to be a big hit. The operating profit fell 48% to 68.5 million, which is off 100.2 million in revenue. And they generated free cash flow of 47.9 million, had net debt of 58.1 million, which is the equivalent to 0.3 times cash profits. So in terms of the price, it's now trading at a PE ratio of 31.7 compared to an average price to earnings ratio of 23.8 since it listed in 2015. And it's currently got a prospective dividend yield in the next 12 months of 1.2%. Oh, the only other thing is they've decided not to pay an interim dividend. So what do you think of Autotrader then, John?
It's in the current environment, it's probably one that I'd be staying away from. I think in terms of the new and used car market, if we're sort of going into second recession and if it really begins to bite next year, the sale of cars, and particularly new cars, I wouldn't be particularly bullish on. So on that sort of macro basis, I'd probably be holding off, and it's not a cheap stock anyway. I'd be a bit wary at the moment.
I'd agree with your interpretation that it's going to rise and fall with the economy, really, because when things are going good, people buy more cars, and in a recession, like you said, people will buy less cars. In terms of how the shares have done over the last year, so a year ago they were at about $5.50 a share, and they're at £6 today, and they're only 12p off the 12-month high. So they're at £6, 603 pence compared to 612 pence yearly high, and a yearly low of 308 pence per share.
Okay. So what's your take on it then? Do you think the share there's a bit more optimism? Or would you
Yeah,
be a bit more optimistic about Autotrader in the next sort of 18 months, 2 years?
it's a quality business. So it's one, it's always been on my watch list. It's just always seemed quite expensive. I did look at it about a month ago when I bought Rightmove, and I compared the two because they are very comparable in the same way where, you know, if you're a car dealership or a used car dealership, you've probably got to be on Autotrader really. And it's the same with if you're a letting agent, you've got to be on Rightmove realistically, just because so many people go there. And I thought Rightmove was the better business. It was a bit more expensive, but I think the margins were a bit better and it looked like it had slightly more pricing power to me.
Yeah, sure.
But it's a quality business. I would probably want it at some sort of discount at the minute.
That's it. Yeah,
because like you say, if we go into recession, you know, it could be a couple of years before it's earning the amount that it is currently. So PE ratio of 31, I don't think it's completely unreasonable, but it's not cheap.
No.
And the market cap's 5.8 billion, and I think when it's primarily it's pretty much entirely UK, I think.
UK,
so,
yeah.
So how big is it actually going to get? Because most of the car dealerships, you'd expect they're on there by now.
In terms of UK growth, is there much more to be had?
And I think that's I'll just have a look at the financials. So in the past 5 years, it's increased revenue from 281 million to 368, and profit has increased from 126 million to 205 million. So they are respectable figures. And what is nice about it is because it's mainly fixed costs, a huge amount of the revenue increase goes straight to profit. Yeah. But it's probably at the stage now where it's only going to be growing revenue at about, I'd say 10 or 15% a year. It's probably quite a reasonable estimate. So then at a price to earnings of 31, it's not unreasonable, but it's just not, it's not cheap.
It's not cheap enough at the moment.
But it is a quality business.
It's quality,
Which is, I think, why the share price has held up so well.
All right. So next on the list, we've got AstraZeneca. So it's mixed news from them. Third quarter revenues rose by 3% to $6.6 billion, with good growth, particularly in their oncology sector. Product sales rising 7% to 6.5 billion, which was a slowdown in comparison with the second quarter, which was 9% growth. And underlying earnings per share were more or less flat year on year at 94 cents. I think analysts' expectations had been about 98 cents, but not that far off. And it's this sort of, again, it's coming back to this quality drug pipeline that Astra have with particularly with their oncology, and the revenues in the oncology division had been up 22% to 2.8 billion. And there've been some positive results from clinical trials. And I think there was one of the ones that they mentioned was Lynparza, which has been approved for prostate cancer in the EU rather. Other parts of the business had seen some sort of drop off. So sort of in respiratory, for example, particularly in the Chinese market, Pulmicort, which is sort of often used for a drug used for asthma, the number of sort of pediatric patients attending outpatients appointments out in China had been down. So that side of the business was down about 12% to $1.2 billion. Other sectors hadn't done too badly. Cardiovascular sales had risen 4% to $1.8 billion, and other medicines up 1% to $739 million. They'd had strong growth in Nexium, and one of their nasal sprays for flu vaccine had been doing well. I mean, one of the big news, or why we see Astra a lot, or what we hear from Astra a lot at the moment, is about the tie-up with Oxford University and the phase 3 trials for the coronavirus vaccine being due later this year. I mean, it's interesting, and certainly as a member of the public, about the coronavirus, but from a sort of purely business point of view, I think Astra's plan had to be to roll it out for no profit, essentially. I mean, it's perhaps promising going forward in terms of Astra's own sort of vaccine development business, but in terms of purely in terms of money, probably is not going to, as they've said, it won't be for profit, not going to have a significant impact on the numbers. Astra, they are still borrowing to cover the dividend, and the net debt at the moment is 13.8 billion, which is up about 15% from the start of the year. And that's largely down to making the dividend payouts. Free cash flow across the last 9 months, about 2.5 billion, which is up over 100% year on year. And they have benefited from the higher profits, and they've guided that they expect the full year revenues to increase on the higher single digits and core earnings per share to be the mid to high teens in terms of percentage. I mean, going forward, some of the challenges, I suppose, would be reduced levels of patients. I mean, we see this in the UK. Most of Astra's profits aren't from the UK, but, anecdotally, you see reduced levels of patients undergoing screening, receiving cancer diagnosis, all of that being delayed. And as they've got such a big oncology side, potential for impact there on the sort of profits going forward. And also the disruption that it's going to be causing to clinical trials, which I'm sure is not insurmountable, but will be a challenge going forward. In terms of the valuation, price to earnings at the moment is about 22, and that's compared with a 10-year average of 15 or around 15. So overall mixed, but probably a bit more on the positive side than the negative. And again, it's another sort of quality UK business. It's certainly up there. It has been at the top of the FTSE 100 in terms of market cap. I think it may be second to Unilever at the moment, but they've got a promising pipeline, quality business, and I imagine that the plans to bring debt down, quality looking business going forward. Any thoughts, Sam?
I think it looks expensive. That's my thought. So like you said, price to earnings of 22.6 compared to a 10-year average of 15. Although the pipeline might be promising, I think that's possibly due to a lot of, for want of a better word, uneducated investors who are buying pharmaceuticals in the hope that you're going to get this miracle cure for coronavirus that's going to make loads of profits for it. And a combination of that and the fact that it is a company that's going to continue to do well in the coronavirus environment. So I think you've got a lot of people piling into it, and I think it looks too expensive for me. The prospective dividend yield in the next 12 months is 2.5%. And I think if you are buying AstraZeneca at today's prices, you probably can't expect a huge amount of capital growth. It's probably, the dividend is a big factor. So for that dividend to only be at around the 2.5% mark, I'd expect 3 or 4% from a company like AstraZeneca, just because I don't think you're going to get that capital growth. So I do agree it's a quality business, but for me, I wouldn't buy it at 22 times earnings.
I don't know. I think if some of the drugs in the pipeline, and this with the chief executive, who came in, I think about 2012, he has been unlocking this a little bit more. So I think probably the price could be justified on the basis that if you've got a number of blockbusters that then do come out, you've got essentially a monopoly on those drugs and the profits for a good few years before the patents expire. But I think that's probably baked into the price. And if you compared it with Glaxo, which I haven't done any research on this week, but Glaxo, you probably think that the pipeline for their company is less promising, and that they might, I'm not sure what they're trading at, but probably closer to the 15. But if you're pricing that in, then 22 might be more justified, I'd say.
But this is a 111 billion pound company. So how much are these new products going to contribute? Especially when you think there's going to be old products being phased out. So the net increase, is it going to be big enough to just, well, I'm sure people will do all right on it, but I wouldn't be confident of it beating the market over the next 5 years.
Yeah, but I suppose this can be the case with pharmaceuticals, that they can sort of almost wax and wane a bit, but once they've got the blockbusters, then it can produce, it can be, well, highly lucrative. I mean, over the last 5 years, the share price, this is sort of excluding dividends, it's done over 100%. So it's not, I'd back Astra at this price.
Would you? Oh.
I think, I think I would. I hadn't, it's not a stock that I own, but looking at the numbers, I'm looking at the pipeline. I think it could be a company that's quite promising in the next couple of years for sure.
Okay, so before you looked at it today, what would you have considered a reasonable price to earnings? Like, were you pleasantly surprised by 22 or?
Yeah, I was. I thought it could be sort of closer to the 30 times, just in terms of what's been going on in the news. And I hadn't, like you say, I hadn't been focusing on it prior to this, but I'd expected it to be a bit more expensive actually than 22. Not that 22 is cheap on the UK market, but I think the potential for growth would be relatively high.
Do you think the bond proxy argument would work for a company like Astra?
I wouldn't be buying it as a bond proxy.
No, it was just a thought.
No. I think perhaps that argument might be made more for Glaxo, but I think if you're looking for a bond proxy, there are far better ones on the FTSE than AstraZeneca.
I think with like a Unilever or a Diageo, it's selling the same. Reckitt, they're selling the same products year after year, whereas you just don't get that with pharmaceuticals.
No, you don't. And yeah, they probably do need to bring the debt down a bit more as well. And they arguably might be better off cutting the dividend a bit, or certainly not growing it at the moment, and ploughing that back into R&D.
It's interesting that they're funding it with debt, though, because I think with what's going on at the minute, with so many companies suspending and cancelling, it would have been quite a good time to just say, we're cutting the dividend, or we're not paying the dividend, and just reset it.
Yeah. No, I agree. I agree.
Yeah, because I don't think they'd have been punished too much for doing that if they'd done it in the past 6 months.
No, and I'm not sure, because there was an offer from Pfizer, but that was a number of years ago. I can't remember whether it might have been 6 years ago. I think that was, just from memory, because it was in a lot of the UK press at the time, whether it was about £40 a share.
So they made the right decision.
They definitely made the right decision.
It's £85 a share today.
£85 a share today. I'd have to fact check that, but that's just from memory from a number of years ago. But
a business you'd be interested in then?
It is a business I'd be interested in. And the price to earnings 22, not cheap, but I think it like I said, I think it can be justified. And it's one of the more interesting companies we've got on the FTSE at the moment. And one that hasn't, like you say, hasn't been hit by, or it has the potential to grow from coronavirus, or hasn't been hit by it like a lot of the sort of, oil and gas and banks, which make up such a big part of the FTSE. But no, I'd be relatively bullish on it.
Oh, there we go.
You're not.
No. So at least our listeners got to hear both sides of the argument.
Okay, so that was Astra. We've got DS Smith. Sam, have you got much to say on that?
No, I don't actually.
Okay.
So they've released a very brief statement in relation to their third quarter results. So the third quarter results aren't out yet, but they have released a statement saying that performance has continued to improve since the beginning of September. And as a result, they expect the half-year results to be in line with their previous guidance. Overall volumes for the first half are expected to be 1.5% behind last year. And they've said the second quarter continued to grow from e-commerce and consumer goods in Europe and the US. They did say that due to disruption from coronavirus, the first quarter means in the first quarter, half-year profits are going to be lower than last year, but they expect to still pay the half-year dividend.
Yeah, and it's a fairly chunky dividend. I mean, I think the yield on the company is about 4.5%.
4.7 prospective yield for the next 12 months. It's currently trading at a price to earnings of 11 compared to a 10-year average of 11.7. So I guess it's been pretty unaffected. Really. It could have been worse, basically. And I guess people are aware that although they've got increased costs because of coronavirus, they do also, more stuff needs packaging because of the move online.
It's positive from a structural point of view that more e-commerce and more boxes are going to be needed. There's an increased demand.
Yeah, so for anyone who doesn't know the business DS Smith, so it's not particularly intuitive from the name, but they basically do packaging. So if you get a parcel from Amazon, I think they still do the packaging for Amazon, don't they?
I think they probably do. I'm not 100% on that.
I know they did a few years ago.
Boxing is what they do.
Yeah, the boxing, sorry, yeah. So they're still a supplier for Amazon. So it's boxing. And then they do paper packaging as well. It looks like they've been hit by a decrease in the paper price and the knock-on impact that's had on box prices. So
I see.
Yeah, so it's in the, I mean, we still don't have the results for the current quarter, but the last release results, they released their full year results to 2nd of July 2020. And that was, I won't go into it too much detail because they are a few months old now, but it's all right. They're not amazing results, but they're okay. So revenues in North Europe fell 9% due to lower paper prices. Southern Europe revenues rose 10% to 2.2 billion, driven by an addition. Eastern Europe revenue fell 3% to 892 million. North America revenue was down 9%, 604 million. Despite the drop in revenue, they managed to keep profit margins stable at 10.9%, which was an increase on the previous year's 10.2%. They reduced net debt in the last full year, and they've reduced capital expenditure, and non-essential spending has been deferred, and headcount, it looks like they're being flexible with that. So what do you think of it as a business then?
It's boring. It's certainly not a sexy business, but I think it from a value perspective, and with the sort of the trends for online shopping, it's something that I think is probably looking quite cheap at the moment, and possibly worth looking into or buying some shares in, I would say.
I was surprised that it was as low as 11 times earnings. I was also surprised that that was actually the 10-year average, 11.7.
The share price in the last 10 years, it has done, I suppose it depends what you're measuring it against, but it's certainly beaten the FTSE.
Not in the last 5, though.
Not in the last 5. No, that's true. Oh, that's true. Yeah,
in the last 10, it looks like it's a double. But the last 5, you're probably down about 20%.
And what's the FTSE down?
So it probably has beat the FTSE, actually.
Oh no, okay. The FTSE over the last 5 years is just 7%. So okay, you've got it there. But certainly over the last 10 years, well, we are about where we were in 2010. So
I'm surprised that Amazon don't make their own boxes. For a number of their bigger customers, it seems like something where if they want to get more efficient, at some point you'd think they'd start making their own boxes. And that's my biggest concern with it.
Yeah. Do you think that would apply to some of the REITs that we discussed a few weeks ago, that they would just use purely Amazon distribution centers rather than third parties? So we discussed the big box REIT.
So I don't think so, because they're so, like, the location's so important. There's just so few of them. So if Amazon want to go and build one, it's easier said than done. And once Amazon have started using a distribution center, it is very, very sticky, because it's not as straightforward as just moving into another, is it? Whereas I think, if Amazon decide that they're going to start making their own boxes in the UK, I think that's easier. Because a distribution center, the location's key, and there's not that many locations like that where it's, it's near a motorway and it's the right size, it's at the right price. With like Tritax, for example, they are generally locked into quite long leases.
I don't know whether there's much more to say about DS Smith. Shares down just over 23% year to date, but it's not particularly expensive. I appreciate the argument you make about Amazon. It wouldn't be a particular concern, I don't think. I don't think it's a huge risk to the business.
No.
So
it'd only be if a number of the larger customers did it. I think if just one did, they could probably.
Yeah. And I mean, they are a fairly large company. What's the market cap?
4 billion, 4.14 billion.
Yeah. All right. So DS Smith, the other big companies on the FTSE reporting this week were the supermarkets. I don't know whether you can count M&S as a supermarket, but we'll start with M&S, and then we'll go on to, again, Ocado. Is it a supermarket or a tech play? Then we have got something that's definitely a supermarket, which is Sainsburys. So in terms of M&S, it hit the headlines this week because it's its first loss in 94 years as a public company. Underlying half-year revenue fell 15% to £4.1 billion, and it had particularly a bad time in its clothes and home department, whereas food was actually quite, well, relatively speaking, did all right. So underlying pre-tax loss of 17.4 million compared with 176 million profit from last year. including the sort of charges associated with the redundancy, about 7,000 staff being axed in August, and that was all related to the restructuring, and losses increasing to 87.6 million. So the bad side of the business really was, clothing and home, and fewer people buying. I mean, big in the men's department for sort of suits, dinner suits, with revenue falling 40.8%. And that as a whole generated a loss of 107 million for the business. And that's compared with 109.6 million profit a year ago in 2019. I think the clothing and home has been a problem for them for a number of years and not generating the profits that it traditionally did. And perhaps it's got, that sort of frumpish, lackluster image, and they've had a number of sort of trying to reboot it, rebrand it, which has never really been that successful. The more attractive side of business is the food side, and they've had a joint venture with Ocado, and sales have grown over 47.9% to 1.16 billion. And the demand for the delivery slots continues to outstrip the capacity that Ocado are able to deliver. They're limited to 345,000 orders a week until it builds more of its robotic warehouses. While the food business has been positive, there have been some parts of it, like the on-the-go sort of M&S, the smaller M&S shops that you might get at train stations and in airports. They've been down because of weaker demand there, and same with the M&S cafes. But like-for-like sales on the food side growing 2.7% the first 4 weeks, the second half, but weaker overall demand meant that total revenues fell 0.3%. In terms of valuation, it's about 9.2 times earnings, 10-year average been about 11.4, and the shares are down nearly 60% this year. And they've said, given all of this, they're not going to be paying a dividend. Sam, do you have any thoughts on M&S as a company?
Yeah, I saw they have a bank.
They do. I think it's quite small.
Yes.
But yes, they do.
It's like I said with Tesco a few weeks ago. Like, what are they doing with a bank? Like, I don't.
Yeah.
Do you know what I mean? Like, if you're a food retailer and and they sell fashion and whatever else, like, who's sat in the board meeting when they say, "Oh, let's go into banking"? Like,
well, I'd have to check my facts on this, but I imagine it's all sort of pre-2007, where it was sort of maximum expansion and covering just about everything under one roof.
I just don't. Anyway, that was just a bit of a rant. I just don't know why supermarkets decide to be banks as well.
I think increasingly they're trying to get rid of the banks, and I'm not sure whether M&S have any particular plans with their bank, but
yeah. So I thought the price to earnings of 9 on the surface seemed fairly attractive. It depends. I'll just have a look now, but to me that depends on whether or not, current year aside, it's a decline in business or not.
Yeah.
So
it's definitely a business of two halves.
So in terms of revenue, it's revenue's been pretty steady in the last 5 years, but earnings so they give an adjusted figure. So it looks like earnings have been declining steadily. So their adjusted earnings per share, it's dropped from 33p per share in 2016 to 23p a share in 2019. I'm not including 2020 because that probably wouldn't be fair. 9 times earning, but it is a decline in business, so I'd probably just leave it alone, to be honest.
Yeah, no, it's not one I like the look of, and I think I can only see the clothes and the home side getting worse. It has an image problem, and I can't imagine that many people switching to doing online clothes shopping at M&S. Probably the demographic is not likely to be as online, certainly in terms of the clothes. I suppose the food business is more attractive, but then they've got a lot of bricks and mortar stores around the country, and you wonder how much longer can they continue with that, with sort of further lockdowns. The online side and the food, yeah, definitely, but I think overall as a business it wouldn't be one that I'd be investing in right now.
I mean, it said that online sales rose 34%, and they gained market share in that period, but yeah, I think the majority of what they were known for, it's not really translated well into a coronavirus environment. So like you talked about, the the clothing was a big part of the business. Whereas, for example, like we talked about Tesco a few weeks ago, and that just it's not got those problems with the clothing. It's down, but it's not as big a part of the business as it is for M&S. So it just doesn't look like a very good business, really. And didn't they, so you talked about the Ocado, they paid a lot for Ocado, didn't they? I don't know.
Yeah, I'd have to get that.
Do they own half of Ocado? Is that M&S?
Yeah, so it's basically half of the Ocado retail. So I can talk a little bit about Ocado because it does bring us on to that. So Ocado, it had been very positive news, and they were reporting, unsurprisingly, demand was high, customers shifting to online grocery shopping in record numbers, and sales were currently in line with trends seen in the third quarter, with the group expecting full year cash profits of 60 million compared with the previous guidance of 40 million. Retail revenue rose 52% to 587 million in the third quarter. And then the average numbers of orders per week rose nearly 10%, basically 10%, 9.9% to 345,000. So it sort of now gets to the point where the demand is outstripping the supply, and the average order size being £141. So you think going forward, and certainly UK, we've got this new lockdown, which has started today, in fact, that's going to be a positive trend for Ocado. They had announced some acquisitions, Kindred Systems and Hampton Dynamics, combined total of 287 million in order to enhance the robotic systems in their famous automated warehouses. And yeah, this year it had sold half the retail business to M&S. The remainder is Ocado charging retailers to use their robotic warehouses, which they have hundreds of thousands of orders, as I mentioned, per week, with the help of their automated bots. In terms of the partnership with M&S, apparently it's been quite a lot more profitable than they did. They've grown the sort of basket size in comparison with the previous arrangement they had with Waitrose. And yeah, currently price to sales is 6.4 in comparison with their 10-year average of about 2.3. Overall, it is positive from Ocado. It depends really whether you think it's too highly priced, I suppose. But what do you think of Ocado at the moment with the latest update?
Well, so I think firstly, the expected full year cash profits, as they've called them, earnings before interest, tax, depreciation and amortization of 60 million. Earnings after interest, tax, depreciation and amortization will probably be a loss, as it was last year. So last year it talked about EBITDA of 40 million, but the losses were big. I'm presuming it's the depreciation expense is quite high because obviously they've got all these robots and they probably don't last a large number of years before they need replacing. And that, for me, is one of the key problems of the business. It's priced as if it can scale without cost, really. But as it's showing, it is expensive to scale. And the growth, in fairness to it, 40% growth is impressive. It is very impressive. It's good. And it's not Ocado's fault that it's trading at such a high valuation. The performance is good, but it's just nowhere near good enough for me to justify the level it's trading at. And I think a price to sales of 6.4 as well, that is a lot for what is probably going to be a very low margin business, even if it gets to profitability. I can't say my opinion's really improved since the last time we looked at it. I suppose the performance is decent. It's just the valuation is crazy. That's my issue.
Yeah. No, I mean, that's fair enough. It's not something I'd personally be looking at, but it's interesting. And
it is.
It'll be one to watch and one to follow.
I do feel like I understand it a little bit more now.
Yes, yeah. No, that's true. I was very confused about what exactly it was. But
I think that's part of the reason is because it is so overvalued. When you look into it and you realize it's selling food and it's helping other online retailers distribute.
Yeah.
It just doesn't click, does it? Because
no, that's right. And
the valuation we do have a lack, so high.
Yeah, and we have a lack of tech in the UK. So it's one of them, an interesting company on the FTSE to have a look at. So yeah, Sainsbury's probably less interesting. It's more your back to basic supermarket. Not such positive news. The pre-tax loss of 137 million, the 28 weeks to the 19th of September, compared with a 9 million profit a year ago, 2019. Associated with this is particularly the one-off costs, and it's about 438 million with the Argos closures. And for reference, back in 2016, Sainsbury's acquired 700 Argos shops at a cost of 1.4 billion. And going forward, they're going to be closing 420 of those.
They are opening 150 new stores for Argos, but they're just opening them in the supermarkets.
Within the supermarket, yeah. Aside from Argos, if you strip out those costs, Sainsbury's reported a 301 underlying profit, which was 26% higher than the 238 million posted last year. But it's really the Argos side that's putting a big drag on it. And overall, it was a 1.1% fall in sales to 14.9 billion. But the grocery sales were up 8.2%, general merchandise 7.4%. And now as well, it's been a big shift to online. So 40% of Sainsbury's sales are online now. And they're doing some cost cutting, and they're planning to shut the meat, fish and deli counters in the supermarkets. And there's probably not that much consumer demand for them. I think Tesco's did a similar thing, and that will reduce some costs in stores. And then the other thing to note from Sainsbury's is that they have decided to pay a 7.3p dividend in lieu of the final dividend that had been delayed during lockdown, which slightly controversial there in the sense that they have been taking some money from the government's furlough scheme and business rates relief, but there doesn't seem to be too much backlash on that at the moment. But no, Sainsbury's, I mean, we discussed Tesco's a few weeks ago. Sainsbury's, to me, perhaps the less attractive of the businesses.
I was very impressed with Tesco. It went from a business that I'd never been interested in and never really looked at to it is on the watch list now. And it's just not as good.
No, well, yeah, simply put, it's just not as good. I don't think there's that much more to say about it.
Out of the three we've looked at, Ocado, Marks and Spencer's and Sainsbury's, which one would you go for? You're not allowed Tesco.
Being not allowed Tesco's. It's a difficult one. If you didn't want the roller coaster ride of Ocado, I'd probably go for Sainsbury's over M&S. So by default, it might be Sainsbury's, but it's not really an endorsement of the business.
Best of a bad bunch.
I'd say so. Yeah.
PE of 10.8 compared to a 10-year average of 11.6, and a prospective dividend yield of 5.3%.
Yeah, no,
let's have a look. Let's see whether or not it's a decline in business. It's increasing.
Is it?
Yeah. So it's gone from 23 billion in sales to almost 29. They bought Argos within the last 4 years though, so that gave them a boost, I think.
Yeah.
So there's one. So 2016 to 2017, it goes from revenue of 23.5 billion to 26.2. I'm guessing that's the year they bought Argos.
Yeah,
it does sound about right.
Yeah, I just don't know what Argos does anymore, because it's it's catalog, and it was almost like a forerunner to like click and collect. But when you've got Amazon,
it looks like the earnings per share has been declining over the last 5 years. So although the revenue's been flat, it's making less money.
I see. Okay, yeah. I suppose it's been quite the supermarket price wars, and all of that. It's pressure on the margins.
Yeah, it is. Yeah, it's probably going to be Aldi and Lidl that have done that.
Yeah. Thanks. But it's been good for the consumer, cheaper food.
It has, yeah. Right. So our final company this week is Upwork. Do you follow Upwork at all, John?
No, I honestly I don't. It's a US listed company.
Yes, it's US listed. It's a gig economy company, so it's for outsourcing. So if you need something doing that would traditionally be quite expensive, you can go onto Upwork and you can basically get people who are happy to do it online, and they're working for themselves, and they'll do it a lot cheaper. A good example would be, we don't do it, but a lot of podcasts, they'll get their episodes transcribed, and then they'll put them on their website so that they can get better search engine optimization. So you might get someone in India to transcribe it for you at maybe $4 an hour or $3 an hour, whatever it is, because although that's very, very cheap in the US or wherever you are, in India, that is a very large amount. It's higher than the average. So it's basically win-win. Whereas in the US, if you want, or the UK, if you wanted someone to transcribe for you, you'd have to pay the minimum wage. And for something like transcribing a podcast, it's not really feasible to pay that, because you could end up paying like £100 an episode or something. It's stuff like that. So I've done a bit of work myself on Upwork over the years, writing articles. I last did it about a year ago. So I used to write articles about Bitcoin and cryptocurrencies, which I got $30 an hour for, actually, which was quite nice.
More than minimum wage.
Yeah. So yes, you don't. It's not always less. People charge what they can justify. But if you're going on and you're offering quite a basic skill, it is in the knowledge that you're going to be competing with people from countries like India, where they are willing to work for a lot less because it just doesn't cost as much to live. But yeah, so it's very, very interesting. It's a market that I would expect to only get bigger and bigger and bigger. More people are using outsourcing instead of hiring staff. It's a long-term trend that I would expect to get a lot larger. So I'm actually a shareholder in Upwork, and today they have announced their third quarter earnings, and heading into the day, analysts had forecast that they would have a loss of 8 cents per share on revenue of 90 million. And they've actually only lost 2 cents per share on revenue of 96 million. So it's been a beat on that front. Their sales are up 24% year over year, and their gross margins are up to 73%. Net loss for the quarter of 2 cents per share is a 33% improvement on the 3 cents per share it lost in the quarter a year ago. And they've said that adjusted for one-time items, they actually had a profit of 4 cents per share. They've updated their revenue guidance, and they said they expect for Q4 to have revenue of 96 to 98 million, giving them revenue of 363 to 365 million for the full year. For 2021, they're expecting 20% revenue growth, which would give them about 437 million, which is an increase on the 407 million that was expected for 2021. So the share price has reacted very positively. It was up 43.6% for the day. So a good day for me.
A good day for you.
But it's been bumpy. So it's now trading at $29 a share.
Mm-hmm. Market
Cap's almost 3.5 billion. So that puts it at about 10 times sales. Share price is $29 a share after the 43% increase today. It has been as low as $5 a share in the last year. So it IPO'd a couple of years ago, and it IPO'd at about somewhere between 15 and 20. And then it just slowly declined to $5 a share, and it's just been coming back up since. I think it hit $5 at about March.
Mm-hmm.
But it had been a steady decline to $5. It's obviously in a growing market, and it is the market leader. But one of the main causes for concern is that growth is quite slow at only 20% a year. And that's in comparison to a rival, which is an Israeli company listed on the NASDAQ called Fiverr, which is a similar kind of business. And Fiverr is about a third of the size, but I think the growth is about somewhere between 60 and 80% per year. So it's growing a lot quicker. Back in the low in March, or around that time, it was actually, I think it had a price to sales of about 3, which on a 70% margin business, gross margin business, that's growing at 20% a year, I thought was ridiculous. But yeah, so now it's at a price sales of 10, which I think for a business that's growing 20% per year with 70% margins, and it is an industry that's likely to get bigger and bigger, I think it's reasonably priced. I thought it was a very good earnings report. Just for a bit of perspective, growth has actually increased slightly. So I think it was growing at about 19% year on year prior to this, and now it's up to, what did I say, 24%. So it's about, I think you can expect long term about that 20% range, which is good, and it's not extortionately priced. I think even after the big increase today, it's still only about 10 times full year revenues, and what would that put it at, 7 or 8 times 2021 revenues?
And out of interest, what made you? Because presumably when you bought it, you must have had a look at Fiverr at the time as well. What made you go for Upwork over Fiverr?
So Fiverr is a new IPOs. I don't think Fiverr was listed.
Oh, I
at the
see.
time.
It wasn't public. Yeah, okay.
So
fine.
I think Fiverr listed late. I actually would be interested in Fiverr,
Yeah.
but the platform I use, Hargreaves Lansdowne, it doesn't let you buy it. IPO'd in June 19.
Yeah.
But yeah, happy with Upwork. It's doing quite well. I like it as a business. What do you think of it?
I mean, certainly the numbers. It been a volatile ride for you, but
It certainly has, yeah.
Yeah, I mean, it sounds growing business, and the numbers better than expected. And I suppose I do quite like the idea of how the business works, in a free market outsourcing, and whether you're in, like you say, whether you're in India, whether you're in America, whether in Europe, UK, everybody can sort of benefit from it, really, as well as the shareholders and the margins that you mentioned at Upwork. So no, I like it.
What do you think of the valuation? Would you be interested in it?
I don't know, to be honest. I think it's not the sort of business that I'd usually buy shares in. When you do have growth like some of these US tech stocks, I guess these valuations can possibly be justified, but I don't know.
I think if it can grow at 20% a year, I think 10 times sales with the gross profit margins, I think it's reasonable.
It's reasonable.
But if the growth slows, even if that growth just drops to 10% per year, that share price is coming down.
Yeah, that's right.
No, I think it's a good business. I like it. Before we finish, of the companies we've talked about today, Autotrader, AstraZeneca, take your pick of the supermarkets. You're not allowed Tesco, though.
No.
Yes, Smith and Upwork. Which one?
I'd probably go for AstraZeneca, I think.
Would you? Oh.
Yeah.
Ocado for me.
Ocado?
No. No, Upwork.
Yeah.
Upwork for me, but I do like Autotrader.
I mean,
it's one I'd be interested in the future, definitely.
Yeah, that's where I'd have it. I do like it, but just not right now.
Yeah. Right. I think we've covered a lot this week. Right. So I guess we'll see you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.